and welcome to Simply Tax. It's Tuesday, October 27, 2020, and Election Day is officially 1 week from today. As often is the case leading up to an election, taxes are in the spotlight, and much has been said, written, and debated about candidate tax returns and the possible tax policy effects of the outcomes of Washington. But as your checking account knows all too well, federal taxes aren't the only category of taxes that you pay. As a result, there are many headlines also swirling in the state and local tax world as well this year, with many states facing budgetary challenges that the pandemic has only exacerbated. With rate increases and other possible changes for some on the horizon, a frequent area I receive questions on in my practice here in Chicago is changing state residency. Now, as we've discussed on the podcast before, while there are some general themes, a discussion about state and local taxes will ultimately need to center on which state and locality that you are paying tax to. Otherwise, the popular answer is, it depends. So, to help us better understand state residency issues, and given the fact there's a very significant constitutional amendment on the ballot in Illinois this year that would permit graduated income tax rates, I'm excited to share with you on the podcast today a conversation I had with David Hughes, a tax attorney in the state and local tax group of Horwood, Marcus & Burke in Chicago, who draws from his unique perspective and knowledge from years of hands-on practical experience to break down what's being known as the fair tax for Illinois and walk through the considerations for changing your state residency. You're not a resident or taxpayer in Illinois like me? Please don't be insulted or hit pause just yet, as I think you'll find the insights that David shares on state and local taxes, progressive tax systems, and the factors to evaluate for changing state residency valuable, no matter what state you call home or even the amount of salt that you're comfortable with. Alright, since I've clearly now exceeded my per episode quota of state and local tax puns in the introduction alone, let's jump into my conversation with David, who you can learn more about in the show notes of this episode available at bkd.com/simplytax. Going or running tax joke, I guess, always for state and local is the answer to almost anything is it seems like it depends, right? And I guess maybe of course it depends on the jurisdiction, right? If we're to be more specific here. But I guess with that in mind, maybe we can start with a specific jurisdiction, the one that we both reside in here with Illinois, and the big issue I know that I've been hearing a lot of questions about, really almost daily at this point in time, I think, because we're so close to the election, is the fair tax. Could you talk a little bit about, I guess, what all the excitement is about?
It's funny. There's an expression that I like to use. I call it the WGN rule. And what I mean by that is most of what we do in the salt world does not make the news. I find it very exciting, but most non-salt practitioners don't find it very exciting. And most of what we work on does not make the news, whether it's print news or television news. But every so often, we will have an issue that catches the public's attention. And so you'll read about it in the paper or you'll see it on WGN News, right? That's why I call it a WGN issue. So this fair tax, in my mind, is very much a WGN issue. In fact, it might be one of the biggest, if not the biggest, news issue that I've seen come from the state and local tax world, certainly in the last couple of years. And yeah, it is something that you are constantly hearing about these days. And so in simple terms, Damien, what it is it's a proposed amendment to the Illinois Constitution of 1970. So Illinois had a constitution for about 100 years, starting in 1870. And then in 1970, Illinois adopted a new constitution. And that 1970 constitution had a provision in it, which in simple terms said that if the state is going to adopt an income tax, then it had to be a flat tax, meaning that it could be imposed at only one rate. And so that's the opposite of what is known as a progressive tax or a progressive rate, where there are different rates at different income levels. So for example, on the federal side, you have a graduated rate scale. So people who make less money will pay tax at a lower rate as opposed to people who have higher incomes who will pay tax at a higher rate. So the rates are graduated or scaled, or they increase as your income bracket increases. So that's what the feds do. That's what many states do. There are probably 30 plus states with an income tax that impose it at graduated rates. But Illinois, and by the way, prior to the 1970 Constitution in Illinois didn't even have an income tax. So for as long as Illinois has been imposing an income tax, it has been imposed at a flat rate. Now that rate can change, and it has changed. That's up to the legislature. The current flat rate in Illinois is 4.95%. What this constitutional amendment would do is it would give the General Assembly the authority to impose a tax at graduated rates. And in fact, in anticipation of this constitutional amendment being on the ballot next month, the General Assembly has actually already gone ahead and passed a bill that has graduated rates in it. Now, that bill can't take effect unless the constitutional amendment is adopted next month. In order to be adopted, Damien, you would have to have 60% of the voters who vote on the amendment. Not everybody is necessarily going to vote on the amendment next month, but those who do vote on it, 60% would have to agree to it or approve it in order for it to become adopted. Or the alternative is 50% of the voters voting in the election, right? So again, not everybody is going to vote on it. So of those who do vote, you need 60% or 50% of the general voting population. So if it's passed, if the constitutional amendment is passed, then the General Assembly already has a bill. They have packaged a bill ready to go that will impose a graduated rate structure effective January 1 of 2021. And under that graduated rate structure, what you would see or what you would find is that anybody whose income is $100,000 or less, they will be subject to tax at actually a lower rate than today. So today, somebody with $100,000 or less of income is taxed at 4.95% in Illinois. If the constitutional amendment passes and this new rate structure kicks in, people with $100,000 of income or less will be taxed at a rate of 4.5%. And then anybody with income of $100,000 to $250,000, it stays at 4.95. So anybody in that range, in that category, will not be affected by this fair tax amendment. And then where it gets interesting are the people with $250,000 of income or more. And this would be for somebody filing individually. So if you're over the 250, then your rate increases, and then that's where it starts to graduate. So it goes from the current 4.95, and then it graduates all the way up to 7.99 for people earning $1 million or more. And I think I said filing separately before. I know the $1 million mark is for people filing jointly. So, but the point here, without getting lost in the weeds, the point is that what this fair tax amendment would do would be to tax higher earners at a higher rate relative to lower earners. So look, today, higher earners already pay more tax because they make more money, right? So they have more taxable income.
Sure.
But this fair tax would again impose a graduated rate so that they actually pay tax at a higher rate as well.
I feel like there's maybe almost a sense of confusion around understanding it, maybe from taxpayers and those that I've been talking to. And I also know there's been a lot of, I guess we'll say, financial support kind of on both sides of the amendment, right? But not the bill itself, as the bill is already in place, like you said. So I don't know, are you kind of seeing and hearing that as well? And what are maybe some of the challenges as to, whether or not we're going to see this go through?
Yeah, it really is amazing. And again, that's why it's become a WGN issue, is because of all the money that has been thrown at both sides of this tax. So It is very much a centerpiece of Governor Pritzker's plan, financial plan, fiscal plan to try to help Illinois. He was very clear about this before he was elected, and he has been very clear about it since he's been elected, that he sees this fair tax, this progressive tax rate structure as crucial to helping Illinois' fiscal condition and to improving that fiscal condition. And I think we all know Governor Pritzker has a lot of his own personal financial resources, and he has donated, I think, close to $50 million in support of this amendment. So it's kind of hard, to turn on the TV these days or to open the newspaper or go on the internet without seeing some type of advertisement or announcement or something on Governor Pritzker's side in favor of the fair tax amendment. But then on the other side, you also have some wealthy individual Illinois taxpayers, the most prominent of whom is probably Ken Griffin from Citadel, who has thrown a lot of his own money against the fair tax amendment because he is, I suppose, I don't have personal knowledge of this, but I suppose he's an Illinois resident. And as an Illinois resident, he is going to have a much higher Illinois tax bill if this fair tax amendment passes. So Mr. Griffin has thrown a lot of his own money against the fair tax amendment. And again, there are commercials and announcements and whatnot against the fair tax amendment as well. So that's one of the reasons why it has garnered so much attention, is because there is so much money being spent on advertising, both pro and con. And as far as confusion surrounding it, I suppose it's a matter of interpretation, because both sides have their own views as to what this is going to do. If you listen to the pro-amendment people, the people in favor of the amendment, the people in favor of a progressive tax, they'll say that this will lower the tax for 97% of the Illinois population, that it's only the highest 3% who will actually end up paying more tax. And that's certainly possible. I haven't done any of the number crunching on this myself. But again, if you just look at how the rate structure works, it's really the people who earn less than $100,000 that will benefit. And presumably there's enough Illinois taxpayers that fall into that category that it could result in only the top 3% of earners actually seeing an increase in their tax bills. I think the concern on the other side is twofold. One is the concern that the numbers that the pro-amendment people are throwing around, again, for example, that this will only affect 3% of the top earners in Illinois. The anti-amendment group says, well, that's under this current bill, right, that has been introduced in Springfield that will go into effect on January 1. But as I said earlier, there's nothing preventing the legislature from changing the rates down the road. So right now, the threshold is $100,000, but who says the General Assembly can't lower that threshold or increase the threshold or increase the rates, on those lower earners? I think that's the concern on the other side, is that whatever numbers are being thrown around today, those numbers have nothing to do with the amendment itself. The amendment is simply a grant of authority to the legislature. That the real concern is, okay, once the legislature has that constitutional authority, what are they going to do with it? And under the current version of the bill, I think it's easy for the pro-amendment people to say, well, these are the results, and it's not that bad, right? Because it's not affecting 97% of the people in Illinois. But who knows what happens in 2022 or 23 when the General Assembly can start tinkering with those rates. So I think that's the concern on the other side, on the Ken Griffin side, and the people who are opposed to the amendment.
Obviously there's a lot of interest in it. Like you said, the financial considerations of what's been put toward, it's enormous, really, compared to other measures. What are some of the potential ramifications of a graduated income tax?
There are probably, I can think of three pretty clear or significant ramifications. One, we want to spend a little bit more time on, and the one that maybe has gotten the most attention is what I would call taxpayer flight, or maybe even wealthy taxpayer flight. The well-off Illinois taxpayers who, if they suddenly have to pay Illinois tax at a rate of 7.99%, aren't going to like it, and they're going to leave. And these tend to be taxpayers who have the means to leave. They maybe already have a house somewhere else, and to the extent they own or run their own business, they're maybe able to do that remotely. So I do think that there is a risk of flight here. And I think we will see some people leave Illinois if this amendment passes. I mean, there are studies that have been done in other states that have increased their tax rates. It's certifiable. I mean, there's proof, there's evidence, that people do leave states when the tax rates go up. So I do think taxpayer flight is certainly one possibility here, and we'll get to that. But the other two ramifications to think about if this amendment passes, and these other two ramifications are a little bit more technical. But one is currently under the Illinois Constitution, the General Assembly is allowed to impose only one income tax, and that's straight from the current Constitution. This amendment, the Fair Tax Amendment, would eliminate that one tax language. So it's a little bit more of a subtle change than eliminating the requirement that the tax rate be a flat rate. And it hasn't received quite as much attention as the flat rate piece of this, but by eliminating the reference to one tax, what it does is it opens up the possibility that you can have multiple taxes on the same income. So, which you couldn't or you can't really do today. So one example would be if the state wanted to impose a special infrastructure tax, or a special transportation tax, or a make our schools great tax, right? They could tax you at your 7%, 7.5%, 7.99%, whatever the rate is. They could tax you on that. And then they could add an additional 1% tax, for infrastructure or transportation or schools. And it would technically be a separate tax. It would be imposed as a separate tax because it might be a one-time, short-term, one-off tax that is designed to raise revenue in a single fiscal year. But it would be considered a separate tax. The General Assembly can't do that today because, again, they can only impose one tax. So this amendment would effectively allow them to impose these one-off, what I would think of as almost a surcharge, in order to raise money for a very particular purpose. The other potential ramification, and this is one that has received some attention, and I think it's a little misleading. We've been hearing a lot in the news recently about how this Fair Tax Amendment could potentially result in a retirement tax or a tax on retirement income. Illinois today is very much an outlier on that. And it's a sore point with a lot of people. Illinois does not tax retirement income. So pension income or Social Security income is not subject to tax in Illinois. That has nothing, on some level, nothing to do with the Constitution, the Illinois Constitution. There's nothing in the Illinois Constitution that says the General Assembly cannot tax retirement income. The Constitution says the General Assembly can't impose a graduated rate, but it says nothing about retirement income. The reason Illinois doesn't tax retirement income is it's political, that there are a lot of retirees who vote. And I think the General Assembly, politically, if you will, is concerned about imposing a tax on retirement income because they're concerned about the backlash from retirees, again, many of whom vote. Well, what the anti-fair tax amendment group is doing is they're spinning the amendment to say, well, if the amendment passes, then it's going to allow the General Assembly to tax retirement income. That's not totally true. Again, the General Assembly could tax retirement income today. However, what the Fair Tax Amendment would do is it would allow the General Assembly to tax retirement income over a certain level. So in other words, they could effectively tax the wealthier retirees, to put it in simple terms. So let's say, for example, the General Assembly today wanted to tax retirement income over $100,000 only, so that anybody whose retirement income was less than $100,000 wouldn't be taxed, a 0% rate, basically. The General Assembly can't do that today because that's a progressive rate. That's a 0% rate from 0 to 100, and then whatever over 100. That's your classic standard progressive rate. So the General Assembly could not do that today. They could. There's nothing preventing them from taxing all retirement income, from 0 up to whatever, at 4.95%. They can do that. So again, it's a little misleading to say that this Fair Tax Amendment will give the General Assembly the authority to tax retirement income. They already have it. But what it will do is it will make it more politically attractive for them, or more politically acceptable, because they can say, again, sort of like what they're saying today with the Fair Tax Amendment generally is, well, it's only going to affect 3% of the Illinois taxpayers. They could do the same thing with retirement income. They could say, yeah, we're taxing retirement income, but only the really rich guys, only the ones that are getting a lot in the form of retirement income. So that is something to watch as well. And it basically just gives the General Assembly another tool in their toolkit to tax income that currently today is not being taxed.
Maybe going back to your point a bit on the flight issue, like you said, a natural step for those that don't like the idea of facing a higher tax rate is to say, well, then I'm going to change my residency and escape to a lower tax rate environment. Is that really a viable option for an Illinois resident? And what are some of the considerations there?
Yeah, so short answer is yes. It's certainly an option. And look, people have been leaving Illinois for I don't know how many years for tax planning reasons or tax reasons. I've seen it in my practice. I know you've seen it in your practice. I think all tax practitioners have seen it. And there's nothing wrong or illegal about that. It's tax planning. But I do think if the graduated or the Fair Tax Amendment passes, I do think that the rate of flight will increase. But I do think that you have to have the right circumstances. And what I mean by that is, one of the misconceptions in this area, and I've talked to a few clients about this, and they've misunderstood sort of how the rules work. But one of the misconceptions is that if you're an Illinois resident today and you leave tomorrow, even if you make a somewhat clean break, that you suddenly and magically eliminate all of your Illinois income tax. And it's just not true. So, and the reason I say that, and I'll try to put this in layman's terms first, is if you're a business owner and you're an Illinois resident and you personally leave Illinois and you move wherever, to Florida, to Texas, whatever state you want to move to, well, if your business continues to operate in Illinois and continues to make money in Illinois, whatever that business is, you make widgets. If you're still selling widgets in Illinois, as a non-resident, you're still subject to tax in Illinois. Now, maybe not to the same degree, right? Maybe you can reduce some of your Illinois tax bill, but if your business does most of its business in Illinois, let's say it's a very local business, if that business continues to operate the same way, moving to another state is not going to help you. In super simple terms, think of somebody who owns an apartment building and they rent it out and they live in Illinois. They're an Illinois resident and that's how they make their money. Well, if they move to Florida, even if they make a completely clean break, even if they bring everything with them, the one thing they're not bringing with them to Florida is that apartment building.
That's right.
It's staying in Illinois. And to the extent that the apartment building remains in Illinois, that now Florida resident is still going to owe Illinois income tax, even though he or she is a non-resident. So that's what I mean by about having the right circumstances. So business owners have to be careful here because, again, there could be some savings if they leave Illinois, but it's going to be a function of how much of their business does business in Illinois. Because the more business they do in Illinois, unless that changes, they're still going to owe Illinois income tax on that.
Yeah, that's definitely something I hear quite a bit of when those conversations come up, that there's that notion that, right, by just simply moving that changes it, but certainly not. But I guess investment income, though, perhaps is that maybe the income that you would zero in on, and the circumstances where maybe it's a little bit more approachable, perhaps.
That's exactly right. That's exactly right, Damien. Yeah, it's the taxpayers who earn the bulk of their income through investment income, through intangible income. The stock market, is maybe the best way to put it. So people who are getting capital gains and dividends and interests from the market, those are the people who, if they successfully change residency, those are the ones who see the major savings. Because, again, this is the sort of the technical tax geek side to it, which is a non-resident remains taxable in Illinois on what we call Illinois source income. Okay, so again, the apartment building in Illinois is a source of Illinois income. The business that sells widgets in Illinois is a source of Illinois income. Intangible assets, your stocks, bonds, etc. Intangibles are considered to be sourced or located in a resident's home state. So if you move to Florida, your stocks and bonds suddenly end up in Florida. Or if you move to Texas, your stocks and bonds are in Texas. So Illinois can no longer tax that intangible income. So yeah, those are the taxpayers who want to think more seriously about this, because those are the ones who generally get greater bang for the buck by changing residency.
So I guess then the natural question that comes from there is, how easy is it? And what are the factors here? I mean, am I just, raising my hand and saying, oh, now I'm a Florida resident, and that's, obviously being in Florida while doing that. But I mean, is that enough, or what's at stake here? And what do I need to do to, I guess, accomplish that sort of a change?
So there's a lot to take into account. A quick story. So I'm working with the Illinois Department of Revenue on a residency case, and one of our clients has claimed residency in another state, and he has now been challenged. And so we're going through some litigation on that. And in talking to the attorney for the Illinois Department of Revenue, the test that she likes to apply, and I've heard other people use this term, but the test she applies is something called the teddy bear test. What she means by that, and it is kind of an interesting way to put it, but what she means by that is residency is ultimately a function of where you view your home. Where do you go home to at the end of the day? And so this attorney uses the term teddy bear test because wherever your home is, or I guess maybe the better way to put it, wherever your teddy bear is, that's where your home is, right? So that if you claim to be a Florida resident, but you've kept your teddy bear at your house in Illinois, then you're probably in the Department of Revenue's mind an Illinois resident, because that's where the teddy bear is. So it's kind of a rough way. What's the expression about home is where the heart is, right? So it's along those lines as well, that where do you really intend to return to at the end of the day? There's a number of factors involved here. And the reason that Illinois, and look, this is not an Illinois specific issue. I mean, New York, my goodness, they have, I don't know how many dozens, if not hundreds of residency cases. And the reason states struggle with this is because you rarely see, in fact, you would never see a residency case with a clean break, right? If somebody truly picks up and leaves, I'm a native New Yorker, and my dad was transferred when I was going into third grade. And I still remember that day when the moving van showed up in front of our house and they loaded all our stuff into the moving van and we left. There was no question that we became Illinois residents the next day. We made the clean break. And if that happens, you're not going to have a controversy. The reason we have controversy is because these are typically situations where you don't have a clean break, where the person claiming Florida residency leaves something behind, hopefully not the teddy bear, but, or the apartment building, but they leave something behind. And what's interesting about that is going back several years, the Illinois Department of Revenue in litigation actually argued that you have to sever all ties in order to lose your Illinois residency status. So that if you are an Illinois resident taxpayer, if you want to claim residency somewhere else, the Department of Revenue said, well, you've got to sever all ties. Sell your house, terminate all club memberships, give up your driver's license, give up your voter registration, the whole deal. And the appellate court said, no, you don't. You can keep a house in Illinois. You can keep a club membership. It's just you have to go through a balancing test. And as long as there's more factors indicating residency in the other state, then you can legitimately file as an Illinois non-resident. So you don't have to sever all ties. But that's what makes the planning important. Because, again, you do have to paint the picture that you've moved your teddy bear to Florida or Texas or wherever. So you're right. I mean, there's a number of factors that go into that consideration. And the way it stands today in Illinois is there are really two factors that are more important than any other in determining whether somebody is an Illinois resident. One of them is not surprising. It's a very, very misunderstood rule, but it's not a surprising rule, which is days in Illinois. The Department of Revenue will look at how many days a particular person spent in Illinois, and then they'll compare it to the number of days that you spent in one other state. Okay, and this is where the misunderstanding comes in. So what I mean by that is a lot of people think of this days rule as a 6-month and a day rule, 182-day rule, where as long as you spend 6 months and a day outside Illinois, then people think, well, hey, I'm not an Illinois resident anymore, right? And I can see the logic in that. The problem with the logic is that's not what the Department of Revenue's rule says. So department's rule trumps logic, I guess, here. What the department's rule says is that you have to spend more time in one given state, whatever state that is, Florida, Texas, whatever that is. You have to spend more time in that state than you do in Illinois. Let's say, for example, you spend 150 days in Illinois. Okay, so you're below 50%. You're less than 6 months in Illinois. You spend 150 in Illinois. You spend 140 in Florida, where you're claiming residency, and then you're spending the difference, whatever that would be, 70 days, 72 days, in Colorado or wherever. It doesn't matter. Colorado, California, it doesn't matter. Illinois would say you're an Illinois resident. Because even though you spent less than half the year in Illinois, you spent more days in Illinois than any one state. In other words, in my example, you don't combine Florida and Colorado or Florida and the other states. It's Illinois compared to other states individually. And so that's a really misunderstood rule because people think all they have to do is spend less than half the year in Illinois and they're home free. And it's not. And this idea that you have to spend more days in another state than Illinois, all that does is create a presumption. Okay, either way, right? It creates a presumption either way, a presumption that you are or are not an Illinois resident. That presumption can be overcome. Right? So if there's a presumption that you are a Florida resident, the Department of Revenue can overcome it by other evidence. Or if the presumption is you are an Illinois resident, that presumption you can overcome. The taxpayer can overcome that presumption by introducing other evidence, which we'll talk about in just a second. But that's actually one of two rules that create this presumption, either for or against Illinois residency. I mean, there are so many factors that go into residency. And for whatever reason, the Department of Revenue chose this one other factor as being so important that it creates a presumption for or against. It's the property tax homestead exemption. So what Illinois says is that if you claim a property tax homestead exemption on Illinois property, then the Department of Revenue presumes you are an Illinois resident. And again, you can overcome that presumption, but that's again something that catches a lot of people by surprise because it's generally not at the top of people's planning checklist, to make sure that you give up that homestead exemption. But I think what happened over the years is the Department of Revenue was seeing a lot of people who were claiming residency in other states, buying real estate, buying homes in the other state, getting a property tax exemption in the other, or a homestead exemption in the other state, and then also keeping the homestead in Illinois. And they didn't like that. The Department of Revenue viewed that as double dipping. But it's something that, again, that catches a lot of people by surprise because in many counties, you don't have to affirmatively elect the homestead exemption every year. It's just something that naturally comes with the property. And so it's not as if people are consciously making this election every year. It's just there. And so a lot of people don't think about relinquishing it when they move. But it's really important that if you want to claim residency in another state, it's really important that you affirmatively and consciously give up that homestead exemption in Illinois. You can keep the house, you can keep the condo.
Sure.
You just can't take the homestead exemption.
You mentioned that there's this presumption that's saying, okay, well, you still are an Illinois resident, even though maybe you were intending to or planning to be a Florida resident, we'll say. I mean, is it difficult to overcome the presumption? I guess, how do you go about doing that, and what support do you need?
Yeah. So again, great question. So a days counting exercise where you spend your days is very, very critical in these cases. And again, at the risk of getting all legalese on, the burden of proof, as we like to say, is on the taxpayer, right? So the taxpayer who claims residency in another state is going to, let's talk about days as the example. That taxpayer will have to prove that he or she spent more time in one other state than Illinois. In other words, the opposite is not true. It's not up to the Department of Revenue to prove that taxpayer spent more days in Illinois. It's the taxpayer that has to prove that they spent more time in some other state. So how do you do that? And that becomes a challenge. So, you can rely on a personal calendar. There sometimes are credibility issues with that. The better way to do it, quite frankly, and there are apps out there today that will help you and assist you with your days counting. So there are ways to do it, I mean, almost literally on your phone, through an app. Another way to do it, and the other two ways actually that come up a lot in our audits, one is airplane tickets. In a simple example, if you're in Illinois and you're going back and forth to Florida, produce your airline tickets and say, I was in Illinois on this day, then I flew to Florida, then I came back, then I went back, blah, blah, blah. And you can relatively easily add up the number of days spent in either location. That's one way to do it. Credit card statements are another way, because credit card statements will show where your card was charged. So if you're using your card every day, especially if you're using it at some retail store, your statement will show where that card was used. So that's another way to do it as well. Those are really, I think, the most common ways that we've seen in audit. That's on the days counting side. And by the way, we can get lost in some of the weeds here, Damien, on what constitutes a day, right?
Sure. Yeah.
You're in Illinois in the morning, you hop on a noon flight to Florida, you land in Miami at 3:30. Is that an Illinois day or a Florida day, right? Illinois does not have clear rules on that for residency purposes. They have some rules on that when it comes to withholding for a non-resident. Different issue, but same problem, right? So that if a non-resident is working outside Illinois, but comes into Illinois to work for a day, but they're only here for half a day, does that count as an Illinois day for withholding purposes? Generally speaking, it does. So I can see where Illinois might use that on the residency side as well and say, look, as long as you're in the state for some part of the day, it's going to count as an Illinois day. So that's an issue to be resolved down the road somewhere. Again, with the Illinois regulation, days counting is very important. And at some point, they're going to have to address exactly what constitutes a day.
We'll say we're on the planning side and not the, defending the what you did side. I guess is the best practice to track it contemporaneously and do it that way. I mean, I assume it's not necessarily a requirement that it's contemporaneous, but I would imagine that just makes it a lot easier.
Absolutely. That is absolutely best practice, because that's the challenge sometimes in residency cases is the taxpayer hasn't done it contemporaneously. And so he or she has to go back and kind of recreate where they were. And again, you can do that through a personal calendar. You can do that through credit card statements, or you can do it through travel records. But the better way to do it would be to try to do it contemporaneously, whether it's through an app or just some means of establishing where you are on that given day. Look, it's not easy, right? But trust me, a lot of the residency cases that I see, there are significant and material dollars at stake. So whatever it requires to come up with a system to track where you are on a given day, to me, from a cost benefit standpoint, at the end of the day, it's probably worth it, because it'll make proving the case in court much easier if you have that clean set of records. But again, please don't misunderstand. Days counting is only one of the factors. It's one of the two most important factors because it creates this presumption one way or the other. But there are some more things that we need to get into, in order to paint the entire residency picture.
Maybe what are some of those? Because I've seen just kind of lists of them, and you've kind of talked about the important ones, but what are maybe some of the other ones that kind of round out that list?
Yeah, so there are some that I put in what I call the low hanging fruit bucket, which are the things that we tend to hear about all the time with residency planning. So that's getting a driver's license in the other state and changing your voter registration. I call it low hanging fruit, Damien, because it's easy, right? I mean, it's easy to get a driver's license in some other state or registered to vote somewhere else. And look, departments of revenue know that, and you will never win a residency case because you got a Florida driver's license, okay? However, you could lose a residency case if you don't get a Florida driver's license. So you want to do the easy stuff. You want to do the low-hanging fruit, but you can't stop there. That's the problem. There's a lot of people think they just have to, check off the easy boxes and then they're done. The two things that I think are the most challenging, and sometimes there's very little you can do about this, but one is family. Okay, so where is your family? So you're claiming, and I don't mean your great uncle. What I really mean is, where is your spouse and kids? And especially if your kids are still dependents. So if you're living in Illinois and you claim Florida residency, and your spouse and your kids are still spending either all or most of their time in Illinois, again, especially because your kids are school-aged dependents and they're going to school in Illinois, that's a tough residency case. And I've seen some of them, and they are not easy to win. Now, if, again, every circumstance is different. If that family with the spouse and the kids remain in Illinois, so the spouse remains in Illinois, the working spouse, if you will, is transferred overseas and is working overseas for a few years, I think the person working overseas has a legitimate claim that they are no longer an Illinois resident. And then there was a case in Illinois to that effect. So again, all circumstances are different, but if it's a situation where one of the spouses remains in Illinois and the other spouse claims Florida residency, for example, and is going back and forth between Illinois and Florida, where's your teddy bear? I mean, your teddy bear is your spouse and your kids, and they're in Illinois at that point. So that's a tough residency case. The other tough one is with a business. So that if you're owning and operating your business in Illinois, and you've got a business location in Illinois, you've got employees in Illinois, and one day you say, I'm a Florida resident. That gets a little trickier too, unless your business potentially relocates to Florida. Now, again, all circumstances are different, and you could certainly still build a case that you're a Florida resident, but it helps if the business can move with you, or at least some portion of the business can move with you. So those are the more challenging ones, is where the family and the business remain in Illinois. And again, sometimes there's really nothing you can do about that. But the other factors, Damien, are somewhat common. So where's your house, right? Now, you can keep your house in Illinois. There's nothing that says you have to give it up, but that's where size of the house comes into play. So if you've got a really, really big house in Illinois and a really, really small one in Florida, not the best facts. If you've got a really, really small house in Illinois and a really big one in Florida, better fact. But certainly the Department of Revenue is going to look at where you have your houses. They're going to look at where your doctors are, where your other professional contacts are. They're going to look at your community involvement. Are you on boards of local charities or local businesses? Are you active in any religious organizations or civic organizations? So at that point, it just becomes a balancing test. And you have to look for as many criteria as you can to support the idea or to support the position that, again, big picture, your teddy bear is in Florida, right? That's where you go home to, or not Florida per se, but any state. That's where you go home to at the end of the day. And you prove that by saying, hey, I'm active in the community and my doctors are down here. I've got my whole network down here. Those are the sorts of things that people need to take into account.
Now, a slightly different but related topic that the pandemic has also turned up the volume on is telecommuting. And as we recently discussed in episode 107 of the podcast, there are some state and local considerations and uncertainties for both employees and employers that come with remote working in states other than the state that the employee would typically work in. Given these challenges with telecommuting across state borders, I wanted to hear David's take and best practices for approaching the situation.
Certainly check the rules in any given state, because again, some states have formally announced that they are calling a timeout, that it's going to be status quo, that they're not going to be out seeking new business, if you will. But some of those states have said that's only good through a certain date, through the end of the year or through some other date certain. So I think best practice would be to get your arms around the states that have made these public announcements and know exactly when that status quo might end, so that you have a date in mind where maybe you do have to start withholding in a given state. Some states have been good about providing guidance. Other states have not. If a state has not provided guidance, I think I would just maintain the status quo and really not do anything at this point to change how you're withholding.
I'd like to once again thank David and invite you to learn more about him in the show notes of this episode, available at bkd.com/simplytax. If you haven't already, please leave us a rating and review out on Apple Podcasts. We use this feedback in your emails to simplytax@bkd.com to make the podcast better for everyone. And they go a long way in helping others find Simply Tax. You can find me out on Twitter at Damien Martin CPA, on Instagram at TaxDad, on YouTube by subscribing to our Simply Tax YouTube channel, and out on LinkedIn. I'm Damien Martin, and thank you for listening.
The information contained in this episode of Simply Tax is based on data available as of the date of its release. BKD is under no obligation to update this information if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.